If you had the chance to buy into a new technology before the crowd understood it, would you have taken it? Most people think the answer is yes, but that is usually not true. Most people say they would have bought after they already know the result. They look backward at a stock that rose 20 times and imagine that they would have had the courage, clarity, and discipline to buy it before the world cared. But the truth is different. When a company is under $1, when the technology is unproven, when the revenue is small, when the market is not paying attention, when the balance sheet is fragile, when the story sounds too early, and when everyone else is ignoring it, most people do not buy. They wait. They say they need more proof. Then the proof arrives in the form of a higher price. That is how early stage investing works. The evidence gets better as the price becomes more expensive. The opportunity looks obvious only after the uncertainty has already begun to resolve. That is why I do not look at a 10-bagger only as a price move. I look at it as a signal. It tells you that a small group of investors understood something before the crowd did. It tells you that preparation mattered. It tells you that the insight did not suddenly appear when the stock became famous. The insight was built earlier quietly when the outcome was still uncertain. There is a phrase in the source argument called a woodshed signal. I like the idea because it describes how real skill shows up. Anyone can walk on stage after a theme is popular and say the right words. Anyone can say quantum computing is exciting when Nvidia is making announcements and the whole market is looking at the sector. But calling attention to the same theme in 2023, when the stocks were neglected, when the companies were small, and when the crowd had no interest, that tells you something different. It tells you the person had spent time in the woodshed. The result becomes evidence of preparation. That does not mean every future call will be right. It does not mean past success guarantees future success. It does not mean you should blindly follow any person or any stock, but it does mean the process is worth studying. In investing, the quality of the process matters more than the excitement of the outcome. A 2000% move is exciting, but the important question is not, how do I chase the next one? The important question is, what framework would have allowed me to recognize the possibility before the crowd? That is where most investors fail. They see the outcome and want the shortcut. But the shortcut is usually a trap. The real advantage comes from building a baseline before the market forces you to act. You study the technology, you study the companies, you study the architecture, you study the revenue, you study the cash burn, you study the customers, you study the dilution, you study the difference between a real signal and noise. Then when something changes, you are not reacting blindly. You are updating a model. That is what good investing is. It is not guessing, it is not excitement, it is not buying because a chart went up. It is making decisions from a prepared mental map. That is why the 37% rule in the source is useful as a metaphor. In mathematics and decision theory, the idea is that in certain selection problems you spend the first portion of time observing. You do not commit immediately. You learn what good looks like. You build a comparison set. Then after that observation phase, when you see something that clearly beats the baseline, you act. Whether or not you apply the exact rule mechanically does not matter here. The principle matters. Watch first, build a baseline, then move when a real signal appears. Most investors do the opposite. They ignore a sector when it is quiet. Then when the sector becomes exciting, they have no baseline. They do not know which company is real, which one is promotional, which one has revenue, which one has lawsuits, which one has a working system, which one is only a dream, which one is burning cash with no path, and which one is positioned as infrastructure rather than a single bet. So they buy emotion, and buying emotion in early stage technology is dangerous. Quantum computing is especially dangerous because the potential is enormous and the uncertainty is enormous. That combination creates extreme outcomes. Some companies may become very valuable, some may fail completely, some may dilute shareholders heavily before the technology matures, some may be acquired, some may become platform, some may never generate meaningful revenue. The sector can produce a 10-bagger, it can also produce a 0. Both are possible. That is why the right mental model is not certainty, it is portfolio construction under uncertainty. To understand quantum investing, you first have to understand that quantum computing is not one thing. There are several different ways to build a quantum computer, and each approach has different strengths, weaknesses, engineering challenges, and commercial timelines. For the first time, the public market is beginning to offer exposure across all 4 major architectures. That matters, because you are no longer forced to bet everything on one scientific path. You can build a basket of approaches. That does not remove risk, but it changes the risk. It moves you from one binary bet toward a broader exposure to the development of the sector. The first architecture is superconducting. This is the area where companies like D-Wave and Rigetti appear, though they use different forms and have different positioning. Superconducting systems often require extreme cooling and advanced engineering. The potential is large, but the technical challenge is significant. D-Wave is important because it was the example that produced the massive move from under $1. It uses a superconducting approach called annealing, which is focused on optimization problems that can be useful. Now think about routing, scheduling, supply chains, drug discovery, and financial risk modeling. The key here is that D-Wave is not only a distant science project. Customers are already using its technology for certain kinds of problems. That matters because in early stage technology, real commercial use is a major signal. It does not guarantee success, but it separates a company with a product being used today from a company selling only the dream of tomorrow. The revenue growth described in the source was dramatic, with full year 2025 revenue rising sharply year over year, and early 2026 bookings in January and February exceeding the entire prior year's revenue. If that is sustained, it tells you that customer interest is moving from curiosity toward adoption. Again, that does not mean the stock is automatically cheap. A stock can be real and still overvalued. A technology can be promising and still punish late buyers. A company can grow revenue and still burn cash. But bookings and customer demand are signals worth watching. D-Wave also matters because it acquired a second quantum architecture, adding gate model capability alongside its annealing system. The source describes an 8-qubit operational system, a path to 17 by mid-2026, and 49 by 2027. If the company can develop multiple architectures, the market may eventually view it differently, but you still have to separate narrative from execution. A roadmap is not a result, a contract is not cash collected, a technical milestone is not a sustainable business model. The investor's job is to track whether each promised step becomes real. IonQ represents a different architecture, trapped ion. Instead of superconducting circuits, trapped ion systems use individual atoms held in place by electromagnetic fields. These systems are known for precision. IonQ has been one of the largest quantum pure plays by revenue and market capitalization. The source highlights several key developments: backlog expanding significantly from the last coverage period, revenue tripling year over year, and a major planned acquisition of SkyWater Technology, a trusted U.S. semiconductor foundry. If that acquisition closes and is integrated well, IonQ could gain more control over its manufacturing process on US soil. That matters for a simple reason. Quantum computing is not only a science race, it is also a supply chain race. It is a national security race. It is a manufacturing race. If a quantum company can control more of its production chain, especially inside the United States, it may be better positioned for defense-related work and government contracts. But acquisitions also create risk. A large acquisition can stretch management. It can create integration problems. It can add costs. It can create expectations the company must now meet. In early-stage sectors, investors often celebrate acquisitions before asking whether the business has the operational depth to absorb them. That is why you must watch execution, not only announcements. IonQ may be one of the stronger names in the quantum pure play universe, but strength does not eliminate volatility. It may still be expensive. It may still issue shares. It may still face technical risk. It may still be years away from producing the kind of cash flows that justify a large valuation. The question is not whether it is interesting, it clearly is. The question is whether the investment decision is calibrated. Rigetti is another superconducting gate model company. The source raises an important point: concentration risk. A large portion of the company's 2026 revenue estimate depends on two contracts, including an order from India SC Research Organization and a Novara QPU hardware delivery. The timelines have already shifted from the first half of 2026 to the second half. This is normal in quantum hardware, but normal does not mean harmless. Early hardware companies often depend on a small number of large contracts. If one slips, revenue slips. If one customer changes priorities, the company's financial picture can change. If the roadmap is delayed, investors may reprice the stock sharply. That is why contract concentration matters. It is not enough to ask, does the company have revenue? You must ask, how diversified is that revenue? How reliable are the delivery schedules? How much of the valuation depends on a few milestones? What happens if they slip? Rigetti may have a path, but the investor is betting on the company's superconducting roadmap and its ability to compete against much larger players like IBM and Google, which have far more resources. That does not make Rigetti impossible. Small companies can sometimes move faster, focus more intensely, and produce surprising outcomes. But the risk must be sized correctly. The next company in the source is Quantum Computing Inc., with the ticker CUT. This is where caution becomes especially important. The source states that the company had only $682,000 in 2025 revenue, that its 10K carried a major warning, and that it faces securities fraud lawsuits. Short sellers have alleged that it overstated its relationship with NASA and questioned whether some revenue was real. These are serious issues in early-stage technology. The difference between a speculative opportunity and a dangerous promotion can be hard for inexperienced investors to see. A small revenue base going concern warnings, legal allegations, and highly promotional narratives should trigger caution. This does not mean the company must fail. Allegations are not the same as final judgment, but an investor must understand that this is a very high-risk name. When risk is that high, position sizing becomes the only thing standing between speculation and ruin. A stock like this may move dramatically. It may create large gains if sentiment turns, but it may also destroy capital if the underlying business fails. Lawsuits worsen, dilution accelerates, or the market loses confidence. The important lesson is not just about CUT. It is about the category early. Stage pure plays often have tiny revenues, big claims, heavy cash burn, and extreme volatility. If you cannot distinguish between a real commercialization path and a story stock, you should be very careful. Now let us move to the new entrants, because this is where the sector has changed. 6 months earlier, the public quantum pure play universe was smaller. Now there are more publicly traded names and more IPOs coming. That matters because a sector becomes easier to invest in when the universe broadens. More public companies mean more data, more comparison, more architectures, and more ways to build exposure. But it also means more noise. When a sector becomes hot, many companies rush toward public markets. Some are legitimate, some are premature, some are capital hungry. Some use the excitement to raise money before the business model is ready. That is normal in emerging technology waves. Investors must be selective. One new entrant in the source is Inflection, which uses neutral atom technology. Neutral atom systems are important because they may have scaling advantages. The source argues that they can potentially reach thousands of qubits without some of the engineering nightmares found in other approaches. That is a meaningful claim because scaling is one of the central challenges in quantum computing. Inflection also appears to have strong institutional validation. NVIDIA selected the company for 2 quantum programs. In early-stage sectors, institutional selection can be a strong signal, especially when the selecting company has deep technical knowledge and many alternatives. But you still have to be careful. A selection by NVIDIA is not the same as guaranteed commercial success. It is a signal of credibility, not a final outcome. The more interesting aspect is that Inflection has 2 revenue streams: quantum computing and quantum sensing. The sensing business has deployed hardware, including systems on the International Space Station for NASA, and revenue already above $32 million last year with growth guided for the current year. That is meaningful. Quantum sensing may commercialize earlier than full-scale fault-tolerant quantum computing. If a company has actual deployed systems and revenue while also developing computing, it may have a more diversified path than a pure science bet. This is exactly the kind of distinction an investor must understand. Not every quantum company is waiting for the same breakthrough. Some may generate revenue through sensing software, cloud access, defense work, or specialized optimization before general quantum computing arrives. That can reduce risk, though it does not eliminate it. Then there is Xanadu, which uses photonic quantum computing. Photonic systems use photons and can operate at room temperature. That is an engineering advantage because avoiding extreme cooling can help with scaling and deployment. But hardware is not the only interesting part of Xanadu. The source points to Penelane, an open-source quantum programming framework used widely by quantum developers. It has significant monthly downloads and strong usage growth. This software footprint matters because it may give Xanadu exposure to the ecosystem even if the hardware race remains uncertain. That is a different kind of optionality with Xanadu. The investor is not only betting on photonic hardware, the investor is also watching whether Penelane becomes a standard tool for quantum development. If software adoption becomes broad and durable, it could create a platform advantage. This is very important in technology investing. Sometimes the tool layer becomes more valuable than the hardware race. Sometimes the developer ecosystem matters more than the initial device. Sometimes the company that becomes the language, framework, or middleware wins, even if the hardware landscape remains fragmented. That does not mean Xanadu is safe. The source is clear that revenue is still very early and the stock has been volatile since its public launch. But the software layer gives the company a different profile from a pure hardware-only name. The next company is Horizon Quantum, which focuses on hardware-agnostic quantum software tools. The idea is that if the company builds middleware that works across different architectures, it can benefit regardless of which hardware approach wins. This is an attractive concept because it reduces architecture risk. If you do not know whether superconducting trapped ion, neutral atom, or photonic systems will dominate, a hardware-agnostic software layer can be a way to gain exposure to the ecosystem rather than one horse in the race. But once again, the question is execution. Does the software solve a real problem? Do developers adopt it? Can it monetize? Is it necessary or merely nice to have? Can larger platforms replicate it? Does it become embedded in workflows? Software tools can become valuable if they become standards. They can also disappear if developers prefer other frameworks or if cloud platforms integrate similar capabilities. The source also mentions quantum security names, including CLSQ and ARKit. These are connected to post-quantum encryption and quantum safe key distribution. The idea is straightforward. If quantum computers eventually become capable of breaking today's encryption systems, then organizations must prepare before that happens. Security transitions take time. Governments, banks, defense systems, and enterprises cannot wait until the threat is fully here. That creates a potential market. But the source also describes these companies as pre-revenue and extremely early. That means the risk is very high. Quantum security may become important, but not every company in the area will become valuable. Some may not commercialize, some may run out of money, some may be overtaken by standards, larger security companies, or government-backed solutions. Again, thematic importance does not equal investment success. That is one of the most important principles in emerging technology. A theme can be right while most stocks in the theme lose money. The internet was real, many .com stocks failed. Electric vehicles were real, many EV stocks collapsed. Solar power was real, many solar companies destroyed capital. AI is real, not every AI stock will be a winner. Quantum may be real, not every quantum stock will survive. The theme is not enough. You need company quality, financing, execution, timing, valuation, and survivability. The upcoming IPO pipeline also matters. Quantinuum, majority owned by Honeywell, is described as targeting a very large public valuation. If it comes public, it could become one of the largest quantum companies available to investors. IQM out of Finland and Pasquale out of France are also expected through SPAC routes, according to the source. A growing IPO pipeline changes the sector because new supply comes to market. Investors gain more choices. Existing pure plays face more comparison. Capital flows may spread across more names. The best companies may stand out more clearly. The weaker ones may lose attention. This is why the public quantum universe expanding from a handful of names to many names is important. The game is changing from one or two speculative symbols to a whole sector map. But a sector map requires discipline. If there are 8 or more publicly traded quantum pure plays across all architectures by the end of 2026, an investor must decide whether to pick winners, buy a basket, use ETFs, focus on infrastructure, or avoid the sector entirely. There is no one correct answer. The right answer depends on skill, risk tolerance, time horizon, and whether the investor understands early-stage technology. Now let us talk about the infrastructure layer. This may be the most important part of the framework because infrastructure companies can win even if they do not depend entirely on quantum. Amazon Web Services hosts multiple quantum hardware providers on a single cloud platform. Microsoft Azure hosts several as well. NVIDIA's software platform integrates with a large share of the world's quantum processors, and NVIDIA's venture arm has backed important quantum companies. These infrastructure companies already have real businesses. They have cash flow, they have customers, they have cloud platforms, they have AI exposure, they have developer ecosystems. They do not need quantum to succeed. But if quantum succeeds, they can become toll collectors. That is a different risk profile. A pure play gives you more direct upside if the specific company wins. It also gives you more direct downside if it fails. An infrastructure company gives you indirect exposure. The upside may be smaller relative to a tiny quantum stock, but the survival risk is much lower because the company has other large businesses. This is why infrastructure often deserves the largest allocation in a speculative technology framework. During a gold rush, the miner may strike gold or go broke. The supplier of picks, shovels, transport, and tools may earn money from many miners. That analogy is useful, though not perfect. In quantum, the infrastructure layer includes cloud platforms, software tools, semiconductors, developer frameworks, and companies that can provide access to multiple architectures. These companies benefit from ecosystem growth even if no single pure play dominates immediately. This is how I would think about risk. If you want exposure to quantum but cannot tolerate the volatility and dilution of pure plays, infrastructure is a more stable route. If you want outsized returns and accept the risk of major losses, pure plays may have a role. If you want lottery, ticket exposure, the smallest penny dreamers may have a tiny place, but only with money you can afford to lose. The source proposes a 3-tier allocation. If $100 were allocated to quantum today, $50 to infrastructure, $35 to pure play builders, and $15 to the highest risk dreamers. The exact numbers are not the point. The framework is the point. Anchor the portfolio in companies with real cash flow. Take measured exposure to pure plays where the upside is larger but risk is higher. Keep the riskiest names small because they can multiply or go to zero. That is a sensible structure for a speculative sector. The mistake would be reversing the pyramid. Many retail investors put the largest amount into the riskiest names because those names promise the largest gains. That feels exciting, but it is usually poor risk management. The most fragile companies should not carry the heaviest weight unless the investor has an extremely high risk tolerance and fully understands the consequences. Position sizing is not an afterthought. It is the risk control system. The same stock can be intelligent at 1% of a portfolio and reckless at 30%. The same theme can be productive as a small satellite allocation and destructive as a total portfolio. That is why I do not ask only, what should I buy? I ask, how much, at what price, with what role, and what happens if I am wrong? Those questions protect you. Now, should quantum stock still be bought today? The source answer is maybe, and that is the right kind of answer. People hate maybe because they want certainty, but early stage technology almost always lives inside. Maybe the sector is at the beginning of a multi-year commercialization wave. Maybe the stocks have already priced in too much optimism. Maybe some companies become enormous winners. Maybe many fail. Maybe infrastructure is the safest way to participate. Maybe the pure plays are where the biggest returns will be. Maybe the correction has created better entry points. Maybe the next wave of IPOs creates more supply and volatility. Maybe the technical milestones arrive faster than expected. Maybe cash burn and dilution destroy shareholder returns before the commercial market becomes large enough. The investor's job is not to eliminate maybe, it is to size maybe correctly. This is the essence of risk management. When the probability distribution is wide, position sizing must reflect that. Quantum computing may be a transformative technology. It may change optimization, chemistry, cryptography, material science, defense, finance, logistics, and computing. But the time horizon is uncertain. The winners are uncertain. The revenue models are uncertain. The capital needs are high. The dilution risk is real. That does not mean avoid it. It means respect it. Now let us talk about the psychological shift in the sector. 6 months ago, many investors feared quantum would not work. They asked whether the science would arrive, whether the companies would burn through cash, whether the sector was too early, and whether it was another hype cycle. Now, after major moves and more attention, the fear changes. The fear becomes, what if it works, and I am not in it? This is one of the most dangerous emotional shifts in investing. It is the same uncertainty, but the emotion flips direction. Before the move, uncertainty makes people afraid to buy. After the move, uncertainty makes people afraid not to buy. The fear changes costume. That is why FOMO is so dangerous. It feels like insight, but it is often just fear of regret. The market rises and you imagine the wealth you missed. You stop thinking about risk and start thinking about the version of yourself who bought earlier. You want to erase that regret by buying. Now, but the market does not care about your regret. If you buy emotionally after a large move, you may be transferring wealth to the people who bought when the uncertainty was unpopular. This does not mean you should never buy after a stock rises. Sometimes a rising stock is confirming a real thesis. Momentum can be a signal. Commercial traction can justify higher valuations. A company can move from speculative to credible, and the higher price can be worth paying. But you need to know which situation you are in. Is the move based on real revenue, contracts, technical progress, and balance sheet strength, or is it based on hype, social media, and fear of missing out? That is where the baseline matters. If you watch first, you can tell the difference. If you did not watch, you are guessing. That is why the 37% observation phase is so valuable. It teaches you what normal looks like so you can recognize abnormal. Without that, every price move feels important. Most price moves are noise, some are signals. Your job is to tell them apart. Now let us discuss dilution. Every early stage quantum company must fund research, engineering, hiring, hardware facilities, and commercialization. Many are not profitable. Many burn cash to survive. They may issue shares. When a company issues new shares, existing shareholders own a smaller percentage of the company. The stock price can rise, but your slice of the business may shrink over time. If the company uses that capital productively and grows the value of the business faster than dilution, shareholders can still win. If the company issues shares simply to survive while progress remains slow, dilution can destroy returns. This is one of the biggest risks in early stage technology. The market often focuses on the headline price. Serious investors focus on per share value. If revenue grows but shares outstanding grow faster, the economics may not be as strong as they appear. If contracts grow but losses grow too, you must ask how much capital will be needed before self-sufficiency. If the company must keep raising money at unfavorable prices, early shareholders can be diluted heavily. That is why cash runway matters. How much cash is on the balance sheet? What is the burn rate? How many years of runway does the company have? Will it need to raise again? At what price? How much dilution is likely? Does management allocate capital? Well, these are not optional questions. They are central. A great technology with bad financing can still produce poor shareholder returns. Now, how should an investor evaluate the established names for D-Wave watch bookings, revenue conversion, customer usage, gross margins, the annealing business, and execution on gate model milestones? For IonQ, watch backlog quality, revenue growth, the SkyWater acquisition, manufacturing integration, government and defense opportunities, and whether the company can scale without excessive dilution. For Rigetti, watch contract delivery timelines, revenue concentration, technical roadmap, competition with larger players, and balance sheet strength. For Cup, watch legal developments, revenue credibility, customer validation, going concern risk, and whether the company can prove that the business is real enough to justify the speculation. For Inflection, watch the dual revenue streams, quantum sensing traction, NVIDIA program involvement, NASA, related deployment, and whether neutral atom scaling turns into commercial advantage. For Xanadu, watch photonic hardware progress, Penylane adoption, developer ecosystem growth, monetization of software, and revenue development. For Horizon, watch whether hardware agnostic software becomes essential middleware or remains a niche tool. For quantum security names, watch standardization, government adoption, actual revenue, and whether their solutions become part of real security migration. For the IPO pipeline, watch valuation, cash burn, revenue, customer base, architecture, and whether public market enthusiasm is being used to finance real progress or simply to monetize hype. This is how you build a framework. You do not just buy symbols, you track variables. Now let us talk about ETFs of quantum. Focused ETF can be useful for investors who want basket exposure without choosing individual winners. It can reduce single company risk. It can give exposure to infrastructure, software, hardware, and related companies. It can help investors avoid placing too much weight on one fragile company. But ETFs also have trade-offs. You must understand the holdings. Some ETFs may have large weights in mega-cap companies that have only indirect quantum exposure. Others may hold many speculative names. Some may be more thematic marketing than precise exposure. Fees matter, liquidity matters, rebalancing rules matter. An ETF is not automatically safe because it owns many names. If the whole theme sells off, the ETF sells off. If the holdings are mostly early stage, unprofitable companies, diversification does not remove sector risk, but for many people an ETF may be better than picking the wrong pure play. Again, the principle is fit. A skilled investor may build a custom basket. A less specialized investor may prefer an ETF. A cautious investor may stick to infrastructure. A speculative investor may allocate a small percentage to pure plays. The right choice depends on the investor. Now let us step back and think in terms of systems and cycles. Every major technology cycle has phases. First, the science is not trusted, then the experts begin to understand it. Then capital enters, then public companies appear, then valuations rise, then weak companies raise money. Then the first disappointments arrive, then consolidation happens. Then the real winners emerge: AI. The internet, semiconductors, electric vehicles, and cloud computing all had versions of this pattern. Quantum is somewhere in the early public market phase. More companies are becoming investable. The pure play universe is expanding infrastructure. Giants are positioning themselves. Government and defense interest is increasing. Customers are testing real applications, but profitability and mass commercialization are still uncertain. That means the opportunity is large, but the error rate will be high. Early public market phases are dangerous because investors confuse technological inevitability with company inevitability. A technology can become important while early shareholders in many companies still lose money. This happens because the timing is too long, capital needs are too high, dilution is too heavy, competition is too intense, or valuation becomes too inflated. So the central question is not whether quantum is exciting. The central question is how to participate without being destroyed by uncertainty. That is why I like the layered approach. Infrastructure first, pure play second, penny dreamers last and smallest. The infrastructure layer is the strongest because companies like Amazon, Microsoft, and Nvidia already generate cash flow and have many ways to win. They can host quantum systems, build software platforms, integrate developer tools, invest in winners, and become distribution channels. They are not dependent on quantum alone. Pure plays provide direct upside, but they carry the risk of cash burn, dilution, technical failure, and extreme volatility. Penny dreamers provide asymmetric upside, but also the highest chance of permanent loss. That is a rational hierarchy. Now let us talk about price. A great company can be a poor investment at the wrong price. A speculative company can sometimes be a great investment at a very low price. If the upside is large and the downside is limited by position size, but paying a euphoric price for a speculative company can be disastrous. This is why entry point matters. The source says the correction over the prior period gave better entry points, and that the pure play universe doubled. That may be true, but better does not automatically mean good. A stock down 50% can still be expensive if it was overvalued by 90%. A stock up 500% can still go higher if the fundamentals inflect dramatically. You cannot use price movement alone. You need valuation relative to potential risk, cash, revenue, dilution, and timeline. Early stage valuation is difficult because current revenue may be small. Traditional metrics can be misleading, but that does not mean valuation is irrelevant. You can compare enterprise value to revenue, cash runway, contract backlog, architecture, credibility, customer traction, and the size of the opportunity. You can also manage valuation risk through staged buying. Do not buy everything at once. Build exposure gradually. Let time reveal more information. Add when signals improve or prices become more attractive. Reduce or avoid when the thesis deteriorates. This is how to deal with uncertainty. Now let us discuss what a true signal might look like. A real signal could be a major customer expanding usage after successful testing. It could be revenue growing from experimental to recurring. It could be gross margins improving. It could be backlog converting to revenue. It could be defense or government contracts with real funding. It could be a technical milestone delivered on time. It could be a balance sheet strengthened without excessive dilution. It could be developer adoption accelerating in a software platform. It could be a cloud provider integrating the technology more deeply. It could be industry standardization that favors a company S approach. Noise, by contrast, could be a vague partnership announcement with no revenue, a press release with impressive language but no contract value, a social media cycle, a price spike unrelated to fundamentals, or promotional claims unsupported by financial statements. The ability to distinguish signal from noise is what the observation phase gives you. That is why I would not rush. The fact that a 10-bagger already happened in the sector is not an instruction to chase. It is an instruction to study. What was visible before the move? Revenue, contracts, architecture, market neglect, balance sheet, technical progress. If you can identify the pre-move conditions, you may be better prepared for the next opportunity. If all you see is the price move, you learn nothing. Now let us talk about risk tolerance. Quantum investing is not appropriate for everyone. Some people should not own early-stage technology stocks because they cannot handle volatility. They panic when a stock falls 30%. They overinvest when a stock rises 100%. They confuse unrealized gains with permanent wealth. They cannot tolerate uncertainty. That is not a moral failure. It is a temperament mismatch. A good investment for one person can be a bad investment for another if the second person cannot hold it properly. If you buy quantum stocks, you must expect extreme volatility. You must expect dilution. You must expect delays. You must expect hype cycles. You must expect drawdowns. You must expect that some companies fail. If you cannot accept that, use infrastructure or avoid the sector. There is no shame in avoiding a sector you do not understand. The market offers many ways to build wealth. You do not need every opportunity. You need opportunities that fit your system. Now let us talk about the possibility that this type of 10-bagger may never happen again. That phrase is emotionally powerful, but it must be interpreted carefully. It may mean that the exact opportunity to buy a quantum pure play under $1 before the crowd noticed may not repeat in the same way. Once a sector becomes known, the market prices it differently. More attention enters. More capital enters. More analysts watch. The easy mispricing may shrink, but new opportunities can appear in different forms. A new architecture may be misunderstood. A software layer may be overlooked. A security company may become relevant before revenue appears. An infrastructure company may benefit quietly. A correction may reset valuations. An IPO may be mispriced. A company may deliver a technical milestone that changes the probability distribution. The exact 2023 setup may not repeat, but the broader principle can preparation before recognition still matters. The woodshed still matters. The investor's job is not to mourn the missed 10-bagger. The job is to build the framework that allows better recognition next time. Regret is useless unless it becomes process. If regret becomes FOMO, it destroys you. If regret becomes study, it improves you. That is the choice. Now let us think about how to build a quantum watch list responsibly. First, identify the architecture: superconducting, trapped ion, neutral atom, photonic or hardware, agnostic software. Second, identify commercial traction, revenue, bookings, backlog. Deployed systems, customer types, recurring usage. Third, identify technical milestones, qubit count, error rate, scalability, roadmap credibility, delivery history. Fourth, identify financial strength, cash balance, burn rate, debt, dilution, runway. Fifth, identify strategic validation, government contracts, defense eligibility, major cloud partnerships, NVIDIA or other infrastructure involvement, customer expansion. Sixth, identify risks, lawsuits, going, concern warnings, concentration, delayed deliveries, management credibility, valuation, competition. Seventh, identify role in portfolio, infrastructure anchor, pure play builder, or penny dreamer. This process prevents random buying. You are not trying to predict perfectly. You are trying to improve odds. Now let us talk about the role of government and defense. Quantum computing has national security implications. It can affect encryption, optimization, intelligence, materials, communications, and advanced computing. Governments will care, defense agencies will care, supply chains will matter, domestic manufacturing will matter, trusted foundries will matter. This is why IonQ's potential control of manufacturing through Skywater matters. It is why US-based production can matter. It is why government contracts can be important signals. But government interest can also create distortions. Companies may announce government relationships that sound larger than they are. Contracts may be small. Timelines may be long. Funding may depend on budgets. Defense work can be slow and bureaucratic. Compliance can be expensive, so do not simply see government and assume safety. Ask the size, duration, funding status, and strategic importance of the contract. The details matter. Now let us discuss the difference between quantum computing and quantum sensing. Quantum computing aims to process certain problems in ways classical computers cannot. This is the big dream. But full-scale commercial quantum computing may take time. Quantum sensing can have nearer-term applications. It can use quantum phenomena to measure things with extreme precision. Deployed sensing hardware may produce revenue earlier than general-purpose computing. This is why a company with both computing and sensing revenue may have a more resilient path. If computing takes longer, sensing may provide commercial traction. If sensing validates the engineering, it may support the broader platform. Again, this does not guarantee success, but it is a meaningful distinction. The same applies to software. A company with a developer tool used broadly across architectures may not need to win the hardware race directly. It can become part of the ecosystem. This is why investors must look beyond the most obvious hardware names. Technology ecosystems often reward layers: hardware, software, cloud security, tools, manufacturing, integration. Customers, the winner, may not be only the company with the most exciting lab demonstration. Now let us think about timing again. In early stage sectors, there are usually waves. The first wave is discovery. The second wave is hype. The third wave is correction. The fourth wave is differentiation. The fifth wave is commercialization. Many investors buy during hype and sell during correction. The better investors study during hype, wait during correction, and buy when differentiation becomes clearer. That does not guarantee success, but it is more disciplined. If quantum has already had a major wave, the next phase may require separating real companies from story companies. Revenue, contracts, and cash runway will matter more. Companies with weak claims may be exposed. Companies with real execution may gain credibility. Infrastructure may remain stronger. New IPOs may create both opportunity and dilution of attention. This is why the sector's expansion matters. More companies means the market can compare. Comparison can be brutal. A company that looked exciting when there were only 4 names may look weak when there are 8 or 10. That is healthy. A broader universe forces better analysis. Now, what would make me more optimistic about the sector? More real revenue, more recurring customer usage, more enterprise adoption, more government contracts with meaningful funding, more cloud integration, technical roadmaps delivered on time, reduced cash burn relative to revenue, better balance sheets, less promotional language, more per-share progress. What would make me more cautious? More lawsuits, more going, concern warnings, more dilution without milestones, contract delays, revenue concentration, overly aggressive valuations, promotional partnerships with no substance, insider selling if not explained by normal diversification, hype detached from fundamentals. Those are the variables. If you track them, you are investing. If you ignore them, you are gambling. Now let us discuss how much of a portfolio should go into a theme like this. For most people, the answer should be small. A transformative theme can still be speculative. If quantum becomes enormous, even a small allocation can matter. If it fails or takes much longer than expected, a small allocation will not destroy you. This is asymmetric thinking. You want exposure to upside without exposing your entire life to downside. People often misunderstand asymmetry. They think, if something can go up 10 times, they should put a huge amount into it. But the same thing may fall 90% or go to 0. The power of asymmetry works best when the position is sized so you can survive being wrong. If a 2% position goes up 10 times, it becomes meaningful. If a 2% position goes to 0, you survive. If a 40% position goes to 0, you may never recover emotionally or financially. That is why size matters more than excitement. The source S3 tier structure is useful because it puts most of the money into infrastructure and less into the riskiest names. That is how you can participate without being captured by the most fragile part of the sector. Now let us address the issue of past performance. A stock that went from under $1 to more than 20 times higher is a powerful receipt. But the future return from today's price is not the same as the return from the old price. The old buyer had a different risk-reward profile. The new buyer must evaluate the current valuation, current expectations, and current market psychology. This is one of the biggest mistakes retail investors make. They anchor to the past move and assume the future must resemble it. A stock that already rose 2,000% may still rise more, but the risk is different. Expectations are higher. The easy re-rating may already have happened. Future returns now require execution that justifies the new valuation. That does not make it uninvestable. It makes analysis more important. You cannot buy the old price. You can only buy today. S price. So the question becomes, does today's price still offer attractive risk, adjusted upside given the company's progress, cash burn, dilution, market opportunity, and competitive position? That is the right question. Now let us talk about certainty and probability. Quantum computing is filled with uncertainty. You will not get perfect evidence before the price moves. If you wait until every technical risk is solved, every customer is proven, every company is profitable, and every architecture winner is known, the sector may already be priced very differently. That is the nature of early investing. You are paid for taking uncertainty, but you should not take uncertainty blindly. You take it with diversification, sizing, research, and a clear understanding of what would make you change your mind. That last part matters. Every investment thesis should have falsification points. If the company misses technical milestones repeatedly, does the thesis weaken? If revenue fails to convert, does the thesis weaken? If dilution accelerates, does the thesis weaken? If a competitor achieves a major breakthrough, does the thesis weaken? If customers do not renew, does the thesis weaken? If legal issues worsen, does the thesis weaken? Without falsification points, you are not investing, you are believing. Belief can be dangerous in technology stocks. The market does not reward loyalty. It rewards correct assessment of changing facts. Now let us talk about what makes quantum different from other technology themes. Quantum computing could solve certain classes of problems that classical computers cannot solve efficiently. That means the potential value may be enormous in areas like optimization, chemistry, materials, finance, logistics, machine learning, and cryptography, but it is not yet like traditional software where a company can scale revenues quickly once the product market fit appears. Hardware timelines are slower, scientific uncertainty is higher, engineering challenges are deeper. Error correction, qubit stability, scaling, manufacturing, and software ecosystem all matter. That makes the investment cycle harder. Software investors are used to fast adoption curves. Quantum may require patience. If the market prices quantum like software before the business behaves like software, disappointment can follow. That is why the infrastructure layer is so valuable. Cloud platforms and software frameworks can participate earlier in the ecosystem than some hardware companies can achieve mass scale revenue. Again, architecture matters, commercial timeline matters, capital intensity matters. Now let us consider the ethical and strategic importance of quantum security. If quantum computers eventually threaten current encryption, the transition to post-quantum security must begin before the threat becomes immediate. Data stolen today may be decrypted later. Governments and enterprises know this. That creates urgency. But early security companies still need standards, adoption, customer trust, and integration. The risk is that the need is real, but the winners are not the small public companies investors buy today. Large cybersecurity firms, government standards, open source solutions, or hardware providers may capture the market. This is another example of theme versus company. The theme can be correct. The stock can still be wrong. That is why the penny dreamers should be small. Now let us talk about the role of NVIDIA. NVIDIA appears in the source as an infrastructure winner. It integrates with a large share of quantum processors and backs important quantum companies. This matters because NVIDIA is already central to AI infrastructure and accelerated computing. If quantum becomes more integrated with high-performance computing and AI workflows, NVIDIA may have a role regardless of which quantum hardware approach wins. This is how toll collectors work. They sell to the ecosystem, they provide the platform, they benefit from experimentation. They do not need to know the final winner to make money from the race. Amazon and Microsoft have similar roles through cloud access. Enterprises may not buy quantum hardware directly, they may access quantum systems through cloud platforms. The cloud providers become distribution layers. This is why infrastructure should not be dismissed as boring. In emerging technology, the infrastructure layer can sometimes be the most rational risk-adjusted way to participate. You may not get the 20 times return of a tiny pure play, but you also avoid many zeros. Now let us think about investor behavior during the next year. As more quantum IPOs come, there may be excitement. Each new listing may bring attention, some may spike, some may fade. Analysts may publish reports, social media may amplify narratives, ETFs may attract flows, valuations may become stretched, then corrections may follow. This is normal. Do not let the cycle control you. If you have a framework, you can use volatility. If a quality company falls because the whole sector sells off but its fundamentals improve, that may be opportunity. If a weak company rises because the sector is hot but the business remains fragile, that may be risk. You need the baseline. Again, watch first, learn what good looks like, then act. Now let us address the idea of having a quantum portfolio at all. A quantum portfolio should not replace a core portfolio. It should sit around the edge. The core should still be built on durable assets, diversified equities, cash management, bonds where appropriate, real assets, and whatever fits the investor's life. The quantum sleeve is speculative growth exposure. This is how I would structure it mentally. The core protects your financial life. The satellite seeks asymmetric upside. Never let the satellite endanger the core. Many people do the opposite. They turn the satellite into the core because it is more exciting. Then volatility in a speculative sector determines their emotional state and financial future. That is not a system. That is entertainment with money attached. If quantum is going to be part of your portfolio, define the sleeve size first. Then define the allocation inside the sleeve. Infrastructure pure plays, penny dreamers, ETFs, then define review rules. What would cause you to add? What would cause you to reduce? What would cause you to sell? Do this before the price moves. Rules created during calm are better than rules created during panic. Now let us talk about what it means to be early. Being early is not the same as being wrong, but being too early can still be costly. If a company must issue shares for years before revenue scales, early shareholders may be diluted. If the technology takes longer than expected, capital may flow elsewhere. If sentiment fades, the stock may fall, even if long-term prospects remain. This is why infrastructure and staged buying can help. They give you exposure while reducing the cost of being too early. Pure plays may still be worth owning, but with realistic expectations, you may need to hold through long periods of disappointment. If you cannot do that, do not buy them. Now let us bring the whole framework together. The quantum opportunity is real enough to study. The sector is expanding. All four major architectures are now publicly represented or becoming publicly represented. D-Wave offers annealing with current optimization use and expanding gate model ambitions. IonQ offers trapped ion exposure with scale backlog growth and potential manufacturing control. Rigetti offers superconducting gate model exposure with contract concentration and roadmap risk. CUP offers high-risk exposure with serious revenue, legal and going concerns. Inflection brings neutral atom architecture, NVIDIA validation, and quantum sensing revenue. Xanadu brings photonic hardware and Penylane software adoption. Horizon brings hardware, agnostic middleware. CLSQ and Arkit bring quantum security speculation, Quantinuum, IQM. And Pasquale may broaden the IPO landscape. Amazon, Microsoft, and NVIDIA provide infrastructure exposure that can win across architectures. The framework is clear. The question is not whether quantum is exciting, the question is whether your decision is prepared. Are you buying because you understand the architecture, financials, and risk, or are you buying because you saw the 10-bagger and cannot tolerate missing the next one? That is the difference. The first is investing, the second is FOMO. Now, I want to speak directly to the emotional investor. If you feel a strong urge to buy immediately because the sector is moving, pause. That does not mean do nothing forever. It means do not let fear make the decision. Fear stopped many people from buying when the stocks were cheap. Fear may now push those same people to buy when the stocks are expensive. The emotion is the same, only the direction changed. A disciplined investor recognizes the emotion and steps back. He builds the baseline, he decides the position size, he compares the companies, he chooses the layer. He accepts the possibility of being wrong, then he moves slowly. That is how you participate in uncertainty without becoming its victim. The great opportunities in markets usually arrive with uncertainty attached. If the uncertainty disappears, so does much of the upside. But that does not mean every uncertain thing is an opportunity. Some uncertainty is productive, some uncertainty is fatal. The skill is knowing the difference. Quantum may produce major winners, it may produce another 10-bagger, it may produce several. It may also destroy capital in many names along the way. Both truths can exist together. That is why I would not approach quantum with certainty. I would approach it with a system, observe, map the architectures. Separate infrastructure from pure plays, track revenue and bookings, watch cash burn and dilution, respect legal and going concern warnings, use position sizing, diversify within the theme. Do not let the speculative sleeve dominate the portfolio. Buy signals, not headlines. That is the process. The 10-bagger from 20 to 23rd of May never repeat in the same form. But the lesson can repeat. Preparation before recognition creates advantage. When the crowd is asleep, study when the crowd wakes up. Use the baseline you built. When fear flips from, what if it fails, to, what if I miss it, pause, and check whether the decision is calibrated. That is how you turn an exciting sector into an investable framework. Without that framework, quantum is just another story. With it, quantum becomes a field of probabilities that can be sized, tracked, and understood, and in a sector where the difference between the winner and the loser can be enormous, that discipline may matter more than the name you choose. Because the biggest risk is not missing one stock. The biggest risk is entering a high volatility technology cycle without a system and letting emotion decide what preparation should have decided first.